Hi, everyone. Welcome to the webinar and workshop series offered by TCS in view of the upcoming management case study examinations happening in November 2025. You are with me, Jared, and in this workshop, I will be taking you through the F2 syllabus overview, followed by a discussion of an F2 mock exam task, which we refer to as masterclasses in our program. After that, we would look at a 3-week study plan for those who are yet to get started in preparation of the examination. And the session would finally include a Q&A session where you can raise any questions that relate to today's workshop or anything in general in preparation of the examination. So a reminder about the upcoming workshops and the webinars coming up. So next Saturday, same time, we would have the workshop relating to P2, which will have the same session plan as today's, and we would also follow it up with a workshop on E2. So those would be on Saturdays. Please make sure that you attend these workshops in preparation of the examination. All right, so first things first, before we dive into an F2 task, let's go through the F2 syllabus overview to familiarize ourselves with the F2 syllabus content. So in this document, which we have shared as the TCS mock exam syllabus coverage, we've outlined the P2, F2, and E2 syllabus areas that we've covered, and it would be an easier summary for you to refer to. So the F2 syllabus has 5 main syllabus components: financing capital projects, group accounts, integrated reporting, analyzing financial statements, also referred to as financial ratio analysis, and then financial reporting standards. So let's go through these 5 main syllabus areas one by one. And let's start with the first syllabus component, financing capital projects. Now, simply, this syllabus component relates to sources of finance, where you are expected to be thorough with the different sources of finance a company would be able to use to fund its investment needs. So we are looking at equity as well as debt. And remember, with regard to equity, you have ordinary share capital, which is how Ressett has funded itself, but you also have the option of preference shares. And it would also be helpful if you know the basics about a new share issue, a rights issue, because those are likely scenarios which would come up in the exam if the company wants to fund its operations or investments using equity. Please also be aware of options with regard to debt. Remember, you can opt for a bank borrowing. And if you are a listed entity, and if Ressett becomes a listed entity, then it opens up the capital market for you. So you have the options of debentures and bonds to raise debt finance. The weighted average cost of capital. So it's important that you have a conceptual understanding of WACC. And we've also seen questions from past exams where the examiner had tested your ability to advise the board on the suitability or limitations of using the weighted average cost of capital as the discount factor in investment appraisal. So, repeatedly, we've seen that candidates have not performed well in these questions because examiners' reports would highlight that most of the answers were not up to mark. So please make sure that you are thorough with WACC and the different ways in which WACC could be tested. And we've also seen that the examiner assess WACC in terms of how certain business decisions, such as an acquisition or a product recall in the past, would impact the WACC. So not only a conceptual understanding, you should also have a deep understanding of WACC so that you know how its application could be tested in the examination. So that's about financing capital projects, and we've definitely seen questions from sources of finance, especially with regard to characteristics of debt and equity, which is actually a popular question in the examinations and one which candidates have usually performed well. Moving on to group accounts, remember uh, investments by an entity in another entity can give rise to different group structures. So at the very basic level, you could be tested on how we should account for subsidiaries. Remember, you could have a subsidiary in Lamland, or you could also be looking at a foreign subsidiary when it comes to Ressett. You should be aware of the goodwill calculation aspects, and we've seen examiner test your ability to identify challenges associated with calculating the goodwill and how those challenges could be overcome. And this is actually a challenge for candidates who have even attempted the OTQ examinations and have passed the OTQ examinations, because you perform the goodwill calculations when you prepare for the F2 OTQ exam, but you don't necessarily study the practical challenges associated with calculating goodwill in real life. So this is where the management case study uh, goes beyond the numbers and tests your real world understanding of these concepts. So we've got you covered. It's there in one of our upcoming mock examinations where we discuss about the challenges in calculating the goodwill. And please also be aware that when you do not acquire a company as 100% or a wholly owned subsidiary, it gives rise to non-controlling interest. And there are two ways in which we can value the non-controlling interest, which could also be tested. There can also be fair value adjustments relating to uh, the subsidiary, and especially when it comes to the goodwill calculation and when it comes to preparing the consolidated financial statements yearly. So you should also be covering this within the topic of group accounts. And furthermore, group account structures could also involve joint ventures where two or more entities jointly control the business, and the accounting treatment is the same as that of associates. So within your preparation of joint ventures and associates, please make sure that you understand how the accounting treatments uh, will be the same for both, because it will be easier for you when it comes to the examination. However, remember, we have dedicated financial reporting standards outlining joint ventures as well as associates. We move on to integrated reporting. This could be a key topic in the exam this time, considering the fact that we have extracts from the sustainability report, and we have been provided a newspaper article which discusses about the issue of e-waste and what companies are doing about controlling e-waste. So, as you know, integrated reporting goes beyond reporting financials, and it looks at various other aspects, especially what we refer to as the ESG aspects in today's day and age. So please make sure that you have a thorough understanding of integrated reporting, a conceptual understanding, together with the 6 capitals that we would be covering in an integrated reporting approach. Because past exam questions have tested how different capitals would need to be reported in the financial statements, and how certain developments within the business, certain business decisions taken by the management would impact the capitals of the company. So another important area when it comes to integrated reporting is the 6 capitals. Moving on, the financial statements analysis. So remember, uh, there are 4 categories of ratios that you should be thorough with: profitability, liquidity, efficiency, and capital structure. And in particular, we've seen that ratio analysis related questions have linked the ratios to certain developments or decisions taken by the business. So rather than a standalone question where you could be required to analyze given ratios, you could also be tested on how certain ratios such as gearing or return on capital employed would be impacted due to an acquisition or due to an expansion or any other business development. And the question could also be worded in a very general sense, where you could be asked how uh, the decision would impact the profitability ratios of Ressett, or how it would impact the capital structure ratios of Ressett, or how it would impact the liquidity related ratios. So it is necessary in preparation of the examination that you are aware of the key ratios within each of these categories, and thereafter, based on the requirement, you should be able to identify and discuss those key ratios within the examination. So if you refer to the financial analysis document that we've provided, you will see that we've discussed the ratios along with the analysis. So please make sure that you are thorough with the financial analysis that we've performed. As we move on, we have financial reporting standards. So these are the standards within the syllabus. We start with IFRS 3 business combinations. Remember, this could be tested within group accounts. And you could also be tested on IFRS 9 financial instruments. Although we've not seen questions in the recent past, it is within the syllabus, and you could very well be tested on IFRS 9. Consolidated financial statements, once again, remember, relates to group accounts. So you should be aware of how an acquisition is accounted. And this is something we will discuss within today's mock exam discussion. IFRS 11 joint arrangements. Remember, I told you that we have dedicated standards for joint ventures and associates. So you should be aware of the basics about how we determine whether an arrangement is a joint venture and how we account for a joint venture. So this is where IAS 28 comes into play, investments in associates and joint ventures, because both these arrangements are accounted for in using the equity method of accounting outlined in IAS 28. So you should be thorough with IAS 28 as it applies to the accounting of both joint ventures as well as associates. IFRS 15, definitely a standard that would be tested in one of the 6 papers or one of the 6 variants. So it's something that we've seen in the past, and candidates should be aware of the 5-step process to recognizing revenue from contracts with customers. You could also be tested on IFRS 16 leases. So if you take the F2 syllabus, accounting for leases from the perspective of lessor is covered. But we've seen a question where the examiner tested accounting for leases from the perspective of the lessee. Because in the operational case study examination, you learn IFRS 16 accounting for leases from the perspective of the lessee. So it is assumed knowledge that you have progressed, or within your exemptions, you were able to study this topic. So please make sure that you are thorough with both aspects of accounting for leases. IAS 12 income taxes. So the most relevant topic here is how to account for deferred taxes. We don't see that in Ressett's financial statements, but we cannot rule out the possibility that a scenario relating to deferred taxes could be tested, because if it is within the syllabus, it can be tested. That's the bottom line. And although you may not see questions in the recent past, you should not rule out the possibility that this standard could be tested. IAS 21, the effects of changes in foreign exchange rates was tested in the most recent sitting, and it could be tested again. You should be thorough with accounting for a foreign subsidiary in terms of IAS 21. And you should also be familiar with how we would be accounting for foreign currency transactions. So those are 2 different aspects: accounting for a foreign subsidiary, in which case we would have foreign currency translations, and accounting for transactions which involve foreign currency. So if we are importing or if we are exporting, and if we have transactions happening in a different currency to the Lamlan dollar, then you should be aware how receivables and payables and inventory would be accounted for in the financial statements. IAS 24 related party disclosures tested in one of the recent examination papers. So a standard which does not involve any calculations whatsoever, but it's about financial reporting, could very well be tested. As we move on, we have IAS 33 earnings per share, a ratio which has a dedicated accounting standard. You could be tested at its very basic level how certain decisions could impact the EPS, and at a more difficult level, you could be tested on the diluted EPS, the DEPS as we call it. As we move on, IAS 37 provisions, contingent liabilities, and contingent assets, another popular topic in the MCS examinations, and there is sufficient hint about a scenario relating to provisions, because if you look at the pre-scene, you will see that we are exposed to legal liabilities in many instances. For example, if you take data wipeout related issues, there is every possibility that a customer is suing us because we did not wipe out the hard drives and the data completely, and someone has got hold of the credentials, the passwords, and so on, and has actually uh, misused the data for our own advantage. So in such a case, if there's a legal case against us, how would we go about accounting for it? Well, that is when IAS 37 comes into play. So please make sure that you're also thorough with IAS 37. And as the last accounting standard, we would be looking at IAS 38. And as they say, last but not least, because intangible assets is also a popular topic in the MCS examinations, the examiner could test your knowledge on accounting for research expenses. The examiner could test your knowledge on accounting for internally generated intangible assets or internally developed intangible assets, in which case you need to apply the 6 conditions outlined within the IAS 38. You could also be tested on externally purchased intangible assets, in which case you will apply the 2 criteria that we apply for property, plant, equipment, IAS 16. So please be familiar with the different aspects of accounting for intangible assets within IAS 38. So that's about the syllabus overview. And if you have any questions with regard to the syllabus areas and how they can be tested, you can raise them up in the Q&A session. But for now, let's move on to a mock exam task discussion where we focus on an F2 related topic. So you would recall from the answering technique webinar, Nick discussed the first section of the mock examination, mock exam 1. And I'm sure you would recall you discussed the business risks related requirement. And in today's discussion, we will move on to section 2, where we have a task relating to F2 and specifically group accounts. So let's read through the email. So we are told that the board has officially decided to enter the PC repair and servicing market. However, as you outlined in your earlier report, the board has acknowledged the reputational risks of entering this market under the Ressett brand. Therefore, the board is considering the acquisition of a specialist PC repair and service provider in Lamblin and integrating it into the Ressett group. Please refer to the attached board meeting minutes for more details. So we have an attachment, the reference material, where we have some extracts from board minutes in which there is a discussion about acquiring a specific company which is into providing PC repair and servicing solutions. The finance director wants to meet us both today to discuss matters pertaining to the acquisition. I'm busy working on the investment appraisal and hence would appreciate if you could prepare some briefing notes covering the following. So remember, before you read through the subtasks, you need to read through the reference material, because if you skip the reference material and straight away read the subtasks, your understanding and your interpretation of the requirement would be inaccurate. So let's make sure that we read the reference material first. We are told that the board has formally decided to enter the PC repair and servicing market. and the board has agreed to pursue an acquisition strategy. The board has identified Tech Fix Services, TFS, a specialist chain of PC repair and servicing centers in Lamland as the preferred acquisition target. Founded in 2012 by Andrew Flintoff, TFS began as a small independent repair shop before expanding into a regional chain. It is now regarded as a reputed player in the market, operating 18 service centers across major towns and cities. So, a successful company with an existence of 13 years. And it appears that it is a, a private entity because it's a small independent, it appears to be a small company, and definitely something that we could uh, pursue in terms of an acquisition. TFS offers a broad range of services, including diagnostics, hardware replacements, virus and malware removal, software support, and data recovery. In addition, it provides on-site support packages for SMEs, schools, and local charities, which has become a key growth area. So it appears that the B2B business segment is picking up for TFS, which is good news because we also serve that client base. Remember, we have uh, entities, both commercial and non-commercial, especially those with tight budgets. They purchase equipment from us, so definitely it would be advantageous if we could provide after-sales services using this new subsidiary. The company is well known for its reliability and competitive pricing, earning repeat business from both individual and organizational clients. So that's definitely a good strategic fit with us because we offer competitive pricing, and we've built a reputation around our quality assurance. And this target company is also known for its reliability and competitive pricing. As we read further, full ownership of the business remains with its founder, Andrew Flintoff, who continues to oversee operations as the managing director. So it's owned by one individual, and he is the CEO or the managing director of the company, overseeing its operations full time. The board has agreed that Ressett should seek to acquire a majority stake of at least 75% in TFS. So we have two subtasks. We will discuss subtask A in the workshop relating to E2, but in today's workshop, we will discuss subtask B, which is F2 related. Secondly, assuming we acquire a 75% shareholding in TFS, explain how this investment should be accounted for in Ressett Group's consolidated financial statements. So, at a very basic level, you could be tested on the accounting treatment for an investment by one entity in another entity. So here, the investor is Ressett and the investee is TFS. And we are focused on acquiring a 75% shareholding minimum. And the task is how we should account for it in Ressett Group's financial statements. All right, so we have the full suggested answers made available to you. So remember, those who are with us on our courses, the recommended approach is that you need to attempt these mock exams in exam conditions, 3 hours. Take 3 hours, attempt the exam in full at once, and then read through the suggested answers. Read through the full-fledged solutions. Read through the answers that you are supposed to write in the examination. Thereafter, refer to the answer summaries or answer plans. So in the answer plans, we provide you with a summary of the key points in the suggested answers. So especially when it comes to an F2 related task, it will help you understand what would be the technical points that you are expected to cover within the answer. So that's the whole purpose of providing you with an answer plan, which could also be referred to as an answer summary. So when you attempt a task the next time, or when you come across a similar question in the examination, if the task relates to a technical area such as group accounts and accounting for a subsidiary, you could follow the same approach, the structure that we've shown, and it will help you organize the answer. So the answer plans are not for you to memorize points, but it is for you to understand the key points that have been covered within the suggested answers that we have made available, and what is the step-by-step approach or the technique that we have followed to developing this answer. So that's what you are required to replicate in the examination, not the suggested answers, but the structure and the technique behind developing the answers. So that is where the mock exam answer plans become helpful. And as you would recall, in our master classes, we use these answer plans to explain the key points to be covered within the suggested answers and how you can replicate them in future mock exam tasks. So that's about the resources. So remember, attempt the mock exam, read through the full suggested answers, then refer to the answer plan. Because if you skip reading through the full-fledged suggested answers and straight away jump onto the answer summaries, you may not be able to understand what we have explained here. So a reminder that you should be using these resources in the order in which we suggest. So let's come to the answer discussion. And the first thing is to have an appropriate heading. And in our answers, as well as in the answer plans, we try to make sure that we write a clear and lengthy heading. But although you may not be required to write the headings as we've shown here, please make sure that they are appropriate and clear for the marker to distinguish your response from subtask A from subtask B. So that's the minimum purpose your subheadings should serve in the examination. All right, let's get started, but just a second. The first thing that you would have to explain in your answer is that if an acquisition is presented to you, you should state that the acquisition should be accounted for in terms of IFRS 10 consolidated financial statements. And as per IFRS 10, if an entity has control over another, the investment would be deemed to be a subsidiary. And IFRS 10 has further guidelines on how we would determine control. And we would not be discussing those three aspects in today's masterclass, considering the limited time. And you don't need to go into that detail for this particular subtask, because it is very clear we are looking at acquiring a majority stake, which is a 75% stake minimum, and the remaining 25% will be owned by one single individual in this case, because we were told the company is fully owned by Andrew Flintoff. So if we have 75% of the shares, that means we have majority control in the company, and we can account for this company as a subsidiary unless we enter into a contradicting shareholder agreement with Andrew Flintoff, which is highly unlikely. The whole purpose of investing in this company is to gain control, and therefore in your answers you can state that a shareholding of more than 50% is generally presumed to give control. And in this case, if Ressett acquires a 75% stake in TFS, it definitely becomes a subsidiary. So we would apply acquisition accounting as per IFRS 10. And that would mean we will consolidate 100% of TFS's revenues, expenses, assets, and liabilities in the group financial statements. If you refer to the annotated pre-scene, or if you refer to the pre-scene, you will see that we have produced group financial statements, which would mean that we already have at least one subsidiary. And we would be adding another subsidiary to the group's financial statements, and we would consolidate 100% of the revenues, expenses, assets, and liabilities on a line-by-line basis. So let me illustrate this by referring to the pre-scene itself. So here we are. We have the Ressett Group's consolidated statement of profit or loss. And to these figures, we would add the subsidiaries figures from the SOPL. So it will be a consolidated statement of profit or loss, 100% consolidation of the income, expenses, assets, and liabilities. Of course, we would not consolidate the equity, but the assets and liabilities would be consolidated 100%. So that's where you should start your answer. And remember, goodwill on acquisition should be calculated and accounted for in terms of IFRS 3 business combinations. So this goodwill figure will be recognized as an intangible non-current asset in the group statement of financial position. I repeat, in the group statement of financial position. So in Ressett's SOFP, we will recognize goodwill as an intangible asset in the group consolidated statement of financial position. So remember, you need to explain goodwill, right? And goodwill is an intangible asset. And remember, it is the extra price or the consideration that we pay to acquire a controlling stake in the company. So this is calculated as the excess of the fair value of the net assets of the company. So assets minus liabilities would give you the net assets of the company. So we would calculate the net assets of the subsidiary, and we will convert the net assets to its present market values, or what we call as the fair value. So for instance, if the subsidiary has a building which is shown at its cost historical value, then we would need to convert it to today's market value. And we compare the price that we pay, the consideration as we refer to it, will be compared against the net assets which will belong to us. So if we acquire 100% stake, the 100% of the net assets will belong to us. But since we are acquiring only 75%, the remaining 25% will belong to the founding shareholder, who will be referred to as the non-controlling interest. So this shareholder has an interest in the company, but he does not have a shareholding which would enable him to control the company, and that is why we refer to that shareholding as the non-controlling interest, NCI. So in this instance, when it comes to the goodwill calculation, we should arrive at a valuation for the 25% shareholding which belongs to the non-controlling interest. So after we identify the excess that we have paid over the market value of the net assets or the fair value of the net assets, we will recognize that excess value as goodwill, an intangible non-current asset, in the consolidated statement of financial position. And remember, at each reporting date, we would have to carry out an impairment review to assess whether this goodwill that we have recognized has impaired due to some event. For example, if there was some negative publicity created due to some mismanagement or mistreatment of a customer, and if we no longer have the same reputation in the market for the company, then of course we would be looking at a situation where the goodwill has impaired, because effectively goodwill is about an extra that we have to pay to acquire some intangible assets the company has built. It could be the customer base, it could be its brand, it could be its reputation, it could be the ecosystem which it has built around its existence. So if negative events have impacted the business after the acquisition, it would negatively impact this goodwill, and we would have to carry out an impairment review on the goodwill. We come to the non-controlling interest, a 25% shareholding, which belongs to the present owner. And remember, I said that we need to arrive at a valuation for this 25% shareholding. So we have two methods which we can use to value the 25% shareholding. We can use the fair value based approach or proportionate asset value approach. Now, it is recommended that we use a proportionate share of assets here because TFS is a private firm. There is no market price for the shares of the subsidiary, that is TFS, and therefore we would not be able to apply the fair value based approach directly. So if we were to value how much one share of TFS is worth, we will have to look at a suitable proxy company to arrive at a valuation, because currently this company is not listed and we don't have a market price which we can just find by Googling it. So that is why we recommend that we use a proportionate share of assets, where we will look at the net assets that belong to the subsidiary, and we will identify the 25% share of those identifiable net assets. And it is recommended as the more appropriate method. However, since the question does not specify us which method to use, to the examiner, we should clearly indicate that there are two methods, and this is how both methods would work. And my recommendation in this instance would be to use the proportionate share of assets, because TFS is a private entity. And however the valuation is carried out, remember the NCI value will be shown under equity in the consolidated statement of financial position. So in the equity section, you will see the 25% value attributable to the non-controlling interest. And as we move on, we need to also highlight how we would account for the annual profit. And the annual profit that belongs to the non-controlling interest and the total comprehensive income, because if you have income coming from other sources, which we recognize under other comprehensive income, the portion, the 25% share which is attributable to the NCI, should be reflected separately under the consolidated statement of profit or loss and other comprehensive income. So remember, we will consolidate 100%. This is how we will consolidate, but after the SOPL and OCI, statement of profit or loss and other comprehensive income, we will separately indicate the 25% shareholding, which will belong to 25% shares of the profits and other comprehensive income, which will belong to the non-controlling interest. And moreover, if there are any intra-group transactions, any transactions between TFS, the subsidiary, and Ressett, the parent, any such intra-group transactions, balances relating to those transactions, and unrealized profit in the event we have transferred products among the two entities, we should eliminate them upon consolidation. So those intra-group transactions and related accounts would cancel each other out, because we now prepare accounts for one company, and we would be canceling those transactions out to represent the group performance. So that is how we have structured the answer. And please make sure that you read through the full answer to understand how we have expanded these bullet points into a full-fledged answer. And in the examination, this is what you are required to produce as well, a full-fledged answer as to how we would account for a subsidiary. And also remember, please don't write formulae or equations. You should actually write it as how we have shown here. And that is a skill that you need to develop in the examination. For instance, you can't say EPS equals to profit attributable to ordinary shareholders, divided by. You can't show those signs, but you should be able to explain them to the reader. So that's a skill that you need to develop because you are being prepped to share your finance knowledge with non-finance managers in the workspace. So that's about the F2 mock exam discussion. And as I already mentioned, for those who have not yet started preparing for the examination in November, this could be your last chance to start with a 3-week study plan. And you can take a screenshot of the study plan. We would also be sharing it in the WhatsApp group. So remember, you have to start now, today. So your first week will start from today and will run till next Friday. And after that, you start another week, the second week. And then towards the exam, you will come up with what you are supposed to do in the third week for the examination. So as you will see, if you haven't still watched the pre-sin analysis videos, you have to start from there and you have to go through the series of webinars that we have conducted. And thereafter, you should start doing the mock exams. So please don't skip any steps because you should be ready for mock exams by finishing the pre-sin analysis, understanding answering technique, and then you can fully focus on the mock exams. And those who have enrolled with us with a view of sitting for the exam in February, don't rush the mock exams. And please reach out to us and we will give you a study plan focused on the next 3 months, preparing you for the February examination. Because you should not rush. If you are going to do the exam in February, you need to phase out your learning so that you would be able to make sure that you are familiar and you retain the necessary knowledge from attempting the mock exams and revising them throughout a 3-month period. So that's about the weekly study plan, and this is a success story from the last session. And if you are interested in partnering with us, you can always check out the website for the 2 study options we have. And it's in the premium course that you will have the master classes that we have conducted today for all 6 mock exams. So that would be a total of 20 master classes. And you would also have feedback included for 1 mock exam, which is mock exam 4. So our candidates who are yet to do mock exam 4, please make sure that you prepare well for the mock exam by attempting all 3 mock exams that you have done so far, and make sure that you complete all the steps as per the study plan. And when you are exam ready, please attempt mock 4. All right, so that's about the products, and now is the time for the Q&A. And let me pause the recording to facilitate your questions, and you can also unmute yourself and raise any questions you have. All right, so thank you for your questions, and please feel free to continue to post your questions in the WhatsApp forum or in the upcoming workshops. It could relate to F2 or any other topic, so don't hesitate to raise them up in another workshop. And don't wait till the workshop. Please always reach out to us and clarify your questions, doubts then and there. And before we conclude, a reminder about how you can reach out to us, and also the social media handles through which you can access some of our resources, especially the YouTube and TikTok forums, where you can access the mini video clips where we try to share some content with you. So that's about the workshop for F2, and hope you benefited. And please do feel free to reach out to us and share your feedback. and don't miss out the upcoming 2 workshops. So until next week, have a great weekend and thank you for joining in.